Schedule 1 was first introduced as a form included in the 1040 series back in 2018. One of the goals at the time was to reduce the individual income tax return to the size of a postcard, so that a higher percentage of Americans would file their tax return every year. But as you might have guessed, that didn't work out. The tax code's just too complicated to make it that simple. But they gave it a shot, and the only way to make this form smaller without adjusting any of the tax code is to just move lines. So the IRS just moved a bunch of lines on the old 1040 and made Schedule 1. This is where you'll tell the IRS about any other income that isn't W-2 wages, interest, dividends, capital gains, Social Security, and retirement distributions. And it's also where you'll start to reduce your taxable income by things like student loan interest, self-employed health insurance, IRA and SEP contributions. So let's run down the form. Part 1 is where we'll add to your income. The first line is state or local income tax refunds. And you might be wondering why money that you overpay to your state or local government is taxable. Well, it's only taxable if you got the benefit of a deduction from the tax payment in a previous tax year. So if you claimed that you paid $1,000 of state tax payments on Schedule A of your tax return last year, which reduces your taxable income, but upon filing of your tax return, you actually got $500 back, the next year you have to claim $500 of income, basically to reconcile the state tax deduction that you received in the previous year. Next up is alimony, and then the famous Schedule C. And this is where you'll see your self-employed taxable income if you own a sole proprietorship or single member LLC. You'll detail out your income and expenses on Schedule C, and then the net of all your income and expenses related to your self-employment income gets input here on Schedule 1, line 3. Other gains related to the sale or exchange of assets related to a business is next, and then the summary of your Schedule E. So remember, Schedule E details out the income from rental properties owned personally, as well as K-1 income from partnerships and S corporations. So the details of all those is kept on Schedule E, but the total amount is included on line 5 of Schedule 1. Farm income, unemployment compensation, and then other income. Now this can be lots of things. Gambling income, prizes and awards, stock options, cancellation of debt. Occasionally you'll get a 1099 from an event that you worked or for being a human lab rat. And those aren't really self-employment endeavors, so there's no reason you should report that on Schedule C and pay self-employment taxes on that income. So that's really just income that belongs on this other income line, which is only subject to ordinary income tax rates. So other is obviously a catch-all for everything else that you want to claim as income that you haven't included anywhere else on the return. Now that we can total up the additional income, we need to factor in some adjustments to that income. The educators are allowed to deduct $250 per year for out-of-pocket expenses they have related to fulfilling their duties as educators. There are some business deductions for National Guard and Reserve members who traveled more than 100 miles from home to perform services as a National Guard or Reserve member. If you contribute to an HSA, under certain circumstances you can reduce your income up to a certain amount every year. This is another way that you can save for retirement. Moving expenses are allowed under specific circumstances, and then the IRS lets you reduce your income by 1/2 of the self-employment taxes that you owe them. So you owe about 15.3% just in self-employment taxes on every dollar of self-employed income that you earn if you're a sole proprietor, single member LLC, or partnership. So with a profit of $50,000, that's $7,560 of self-employment taxes that you'll owe. Well, the IRS decides to let you take 1/2 of that amount and use it to reduce your overall AGI, which is what you're taxed on at ordinary income tax rates. So in this example, Schedule 1, line 14 will be $3,825. Contributions to a SEP or simple plan, which are good retirement accounts for self-employed individuals, to really let you put away some money every year, are allowable here. And if you're self-employed, you're not allowed to deduct your own health insurance costs as business expenses. So you must make sure that they end up here so that they reduce your taxable income. Alimony paid is next, and then your deduction for contributing to a traditional IRA. A Roth IRA is not tax deductible when it's put in. It's tax-free when it comes out. So this line is only for traditional IRAs. And lastly, student loan interest and tuition and fees. The student loan interest deduction phases out quickly. I've seen some people that are paying $10,000 in interest every year, and their AGI is over $200,000, so they get no benefit of those payments. And even if they were under the AGI limit, the max that can be deducted is $2,500. The tuition and fees line is for actual tuition payments made to a college or university. There are various education credits that also play into this deduction. And that's all. Total up everything on Schedule 1 and input it on Form 1040, line 10A. Once you have this, you're so close to knowing your AGI, or adjusted gross income.